What's up, everyone? Welcome back to Money Market Truths. I am Mark, and this is...
Hi, guys. This is Mo from OTB Clubhouse.
Yo, Mo, how was your weekend, man? How was everything?
It was good, man. Just been studying the charts and pre-move for FOMC, the pre and the post.
So what I'm
we're going to
hearing
talk about
here
it later.
is...
Go ahead,
So what I'm
sorry.
hearing here is that you didn't spend time with your kid on Father's Day.
I honestly, I did because we had 3 days, right? So I spent one day with him, and it wasn't Sunday, it was Saturday. I spent Saturday with him.
Oh, okay. All right, cool. Same thing. This weekend, I completely
What did you do?
disconnected
Yeah.
on everything. Yeah, I disconnected on everything. Went to a German restaurant last night. I had a great time. So I did not do anything this weekend, but we're back in full gear. Still reading that book, man. I think I left it downstairs. I want to bring it up here to show everyone the compound effect. You guys should definitely check out that book. It's an amazing book. I really think it could change just your entire lifestyle, just in general. It's not just about the stock market. It's just about just in general about having a routine and slowly grinding, because you won't see the effects right away. It takes time. But the difference is if you continue on that path of repeating the same steps over and over, you will see success down the line. It's pretty good, man. Have you read it yet?
I haven't, but you bring an interesting point. We were talking about it, so I'll make it. I'll repeat it. We just don't only want to talk about stocks and option. Any market that makes any money, we want to talk about it. So it's good that you bring that up. I haven't read it.
Yeah, absolutely. Yeah, me and Mo were just talking, y'all. So stay tuned for the future episodes. We're gonna start talking about other things besides just the stock market. Obviously, it's bearish territory. This is not the reason why we're doing it, because nobody's interested in the stock market anymore. People are still interested, but there's so many other avenues and markets that we can touch on that we think people should be informed about. So, and if we don't know about it, we're going to bring people on who know about it. So definitely stay tuned and continue to follow us. Remember, you can catch Mo on OTB Clubhouse on Instagram, and you can catch me on Trading with a Dummy on Instagram, as well as my YouTube channel. But yeah, man, let's get into a little bit of the market talk today. The first thing I want to talk about is dividend stocks, right? So that's what I'm going to cover today. And we're going to talk about the hot topic, which is going to be on WWE. And then Mo was going to teach you guys another strategy here. But first of all, let's talk about the dividend stocks. I'm going to pull up a chart here real quick, or let me see if I can pull it up. Let me make sure this is up and running. Let me know if you see. Let me know if you see this right here.
Yeah, we're good.
Buy. Okay. Now I talked about this earlier last week. I said that if SPY ends up going down to 361 at this bounce right here, where I have the little circle, the red circle, that was going to be the area where there was a demand zone on a SPY on the weekly, as well as it was going to hit the 200-day EMA. And the RSI would show you that was oversold. Now, those were multiple indicators that I said I was relying on in this move. However, there's still fundamentals, and fundamentally still are not quite there yet, right? There's still nothing showing that we're going to reverse in the market. We're still in essentially a recession. I believe we're still definitely going to go lower, but I think there was going to be a quick bounce for a couple of days, because again, we're completely oversold. And with any market, if you're familiar with the way the futures market works and stuff like that, they have to go up to grab liquidity before they drop even lower. So this was the area that I thought it would bounce, and man, did it bounce exactly where I pointed it out at on the demand level. Like if you could zoom in here real quick, I could show you. I got the notification. I put in my mark to get notified when it hit. It was actually 361-ish and like some change. I got notified and I went in and I ended up getting the option, but I did not do a leap like I said I was going to do. I talked about it before. I think I actually even said that I'm not going to do a leap. I may do 3 months out, maybe 6 months, but it was really expensive. So the only thing I was willing to afford and put on the line was, I pull up right here, was a monthly. So the monthly that I had, I felt it was still enough time for it to go up and potentially get at least 100%. But I got the July expiration, which will be the week of the OPEX, I guess. I think it was a month. Yeah, so July 15th. That's kind of early. I thought it was the 4th week of the month.
Nope, that's the OPEX one. You got the right chain.
Okay, yeah, okay, that seems like it's okay. Yeah, but I definitely got in there. So just to show you guys, this is my real account. I deposit $500 in there. Ignore the METV. That was an a play that I tested out a while ago. Nobody's buying it. I invested $152. I mean, it's 93% down. It's not going to make money. It was I think it was a 20. Oh no, it was a 2022, December 2022. That was like when the metaverse was taking off and everyone was talking about it. It has like Nvidia and stuff. Anyways, it went to trash. So it is what it is. And then the MLPDX is a mutual fund, which I had years ago. I liquidated it last year, but for some reason it's still sitting in there. So that's the reason why you see those two. But the SPY play was my play. I bought it for $4.56, and I am now up 16%. Throughout the day, I was up almost 28%, and then it dropped down a little bit there closer to the end of the market. But I definitely think that Monday I may reach my 100% or close to it, and then I'm going to liquidate it. I am not going to hold it for the entire month because, again, I do not think that this is going to last very long. What's your thoughts on that, Mo?
Well, so a couple of things that we look for, and this is pattern. If you can study pattern and you can get really good at it, honestly, you don't even need to watch charts half the time. And this is macro talk.
Oh, sorry, that was weird. Oh, the market closed. It's 4 p.m. Okay, my bad.
So usually the last day of FOMC or the last day of OPEX is usually a big drop. And the week after that, the first day is also bloody red. So you see 2-3% kind of days from both days. This Friday, however, we closed green. It was like, I think we were up by 15 points, not much, but fact of the matter is we closed green. And historically, anytime we close green on Friday, we do close green on Monday, which puts Mark for another point move. And even if we move, let's say 2%, which is what we've seen, 1 to 2%, it should bring Mark up around 100%. Another thing is long weekend. Historically, long weekends are green most of the times, and there's a percent, I think it's 73%. You can go look at it, and everything got exhausted at key levels. So that was the right place to grab it. And no, like, so that was a 1 day demand for you. What was the demand?
That was weekly.
So basically, you could imagine how strong that is, because the longer the time frame, the stronger that zone is. So for us to break weekly zone in one go, it's not possible. So that's why he got in the play, and that's why he was confident. And then he bought time, which is what most people should do. Like, he didn't buy a 0 day; it would have chopped him up. So he had it.
Definitely,
yeah, right. So I looked at the flow today. All the puts, we had about close to 30 million in puts after hours come all for IWM, and they were all for July. So usually when they start adding long is because they're building a position. And I think we should get a bounce Tuesday, perhaps Wednesday, and then from there we should see a downward momentum. I think this will be the worst month so far we've ever seen. It will be worse than Feb. It will be worse than March. We're going to probably drop more as well for that. And it's only because of the sheer amount of puts that are coming every single day. But you will profit from the trade.
Yeah, speaking of that, June is historically not a good month. If you look at it, it's usually one of the lower months when it comes to the SPY returns. So keep that in mind. I mean, as well as, again, we are in a recession. Don't care what anybody says, we're headed to a recession. So, or we're already in it. So June is typically not the best performing month for the SPY historically. So, and then I want to talk about a few other things. So there's a bigger group out there. I'm not going to name any specific names, but I'm also seeing it on Twitter quite a bit. People are now, again, talking about dividend stocks, right? Dividend stocks is the play now. This is what everyone wants to put their money in because you get, a nice little return on your investment. Again, I want to be very clear when it comes to dividend stocks, and I wish someone had told me that years ago. It sounds all gravy, right? Hey, you invest X, Y, and Z, and you can make passive income $1,400, $1,500 a month. Well, what they're not telling you is that you typically have to invest $400,000 to $500,000 in that specific dividend fund for you to have a nice little return where you consider passive income where you could live off of. That's the reality of things. But I saw people talking about this one right here. And let me pull this up again. Let me share this screen with you guys. Let me go over here. It's this one, Simon Property Group. Now, again, this is one of the bigger trading groups that was talking about Simon Property Group. And they're saying that this is the time to start buying in. I would say I would have to disagree on this one. Again, I'm not a financial advisor. This is just my opinion and my thesis on this whole process, and I want to kind of give you guys a heads up on it. First of all, you also keep in mind that if you are part of one of these larger groups, there's this thing called a pump and dump that they like to do sometimes. You can physically move the market somewhat if all of the people in that group, if you have thousands and thousands of people buying a specific strike price, it does help that stock move up or your premium move up a little bit at a time, which when that admin calls these out, they're already in that position and they're calling it out. So when everyone else starts piling in, their premium will go up and they typically exit before you even know, meaning that you're going to end up holding the bag. Not saying this is what they're doing. I'm just saying that just keep that in mind in the future when you're part of these larger groups. But they were saying Simon Property Group. Now, if you're unfamiliar with what Simon Property Group is, it is a REIT, okay? And right now, real estate is the last piece of the puzzle I think is going to get hit in this stock market. Do you agree with me there, Mo, on that one?
Yeah, so my understanding is real estate is where stock market was in January. So we haven't even started yet. I think stock and crypto took the biggest hit. Crypto's down more because people were over leveraged. Real estate is going to be the same thing. Now, like if you're a realtor or mortgage broker or have a good understanding of real estate, you understand that location's very key. So of course, some locations aren't gonna face the same kind of heat than the others, but I don't think real estate hasn't even remotely started yet.
Yep. And so saying that you should invest into Simon Property Group, I think is a very dangerous play in my personal opinion. Again, if you look at what Simon Property Group invests in, it is malls. It says it right here: shopping malls, outlet centers, and community style life centers. Now, if you've been in a mall recently, besides obviously there are these, legacy malls that are known and would probably never run out of business. They have them in Las Vegas, they have them in Atlanta, they have them, I think in LA, there's a pretty big one. So there's certain malls out there, but the average mall, I don't know about you, I live in Orlando. There are several malls here. Most of them are dead. Literally, the one that's closest to me, the only reason why it's still open is because it has an AMC theater. And even AMC theater at this point is in danger. Other than that, the next thing they have inside the mall is a DMV. Literally, a DMV inside of a mall. That's what they got going on. All right. So to say that this is going to be the next big play, I think is very dangerous. Let's even look at the 5-year. Look at it here. The 5-year, you're down 39% had you invested in it 5 years ago. Now, if you went like about a year ago, you're down 27%. Year to date, you're down 40%. 40%. And yes, I know, buy the dip. We buy when it's low. When people are fearful, that's when you want to buy. I got you. But you have to think about the bigger picture, micro and macroeconomics. And again, the malls. Okay. Yes, malls are currently going through a transition where they're trying to revamp and put other sorts of businesses and gyms and stuff like that into the malls. And yes, they're probably most likely not going to go away, but their investment, people are not going to charge as much as they used to back in the day for rent. So I don't think that this is going to be a massive play in the near future is the best way to explain it. Now, even if you look here, if you look on Investopedia, it even says it right there with REITs. They're a low interest rate environment. I repeat, it is attractive in a low interest rate environment. Are we in a low interest rate environment right now, Mo?
No, this is probably the highest we're going to see since I've been born.
Exactly. So just keep that in mind. Now, I have some other dividend stocks that I did pull up if you guys were interested in dividend stocks, and I suggest you do your own due diligence. But these are some of the ones I actually invested in. One of them was the Genuine Parts Company, which is a auto parts manufacturer. It's been in business for years. Yeah, year to date is down 7%. But if you compare that to like tech, that's down like 30%. I mean, there's a lot of companies that are way worse than this. So just seeing that the fact that it's less than 10% down year to date should tell you something. Even if you go to the year mark, if you had invested into this a year ago, you're up 2%. 5 years ago, 40%. Now, if you go all the way max, 1,700%. So this company has had an upward trend besides the typical drops that you have, and it has a dividend. Yeah, it's not 8% like SPG, which I think is at 7 point something, but it is at 2.8%. All right, it's a little bit safer. If you look at the 52-week low, it was 115. 52-week high was 142. I'll even go as far as talking about SPLK, which is one that I did invest in myself, which is Star Bulk Carriers. It's a carrier REIT. Not REIT, sorry, is a carrier dividend stock. And that one has a dividend of 24%. Now, obviously, that's very dangerous, right? This is a momentum dividend play. meaning that once they take away this dividend or lower it, it will crash. But I bought into this at $24. And if you can see year to date, you're up 13%. This past couple of days, it did take a hit, I think, or a month. It was down 20%. It went from $32 back down to $26. And that's typically where I've noticed it ranges between 24 and 26 before it jumps up to 32. Then it has a hard resistance, and then it typically drops. But this has a dividend of 24%. And again, keep in mind, year to date, I mean, for you got a year ago, you're up 19%. 5 years ago, 190%. Again, this one, if you go max, though, it's pretty bad. When it first launched, something happened here back in 2008. It probably has something to do with the housing crash and et cetera. So it completely crashed. But if you just look at the 5-year mark, it's been a steady incline up as well. And again, you're up 190% year to date. Then I will even go as far as another one, a dividend stock, AT&T. Now, you guys know one of those, gurus that everyone knows. Used to brag about this when it was at $32. Kept telling people, yeah, buy. I thought $32 was way too high for AT&T, especially with all the debt and the assets they had, which was really bad. But they dropped down to $18, and that's actually when I started buying into AT&T, because I was like, hey, $18 is not bad with a dividend at 5.73%. Plus, at that time, they also separated themselves from Warner Brothers and got a lot of the bad assets off of their books. And that's when I started investing. It wasn't until a couple of days ago when it actually dropped down 5%, because before that it was holding pretty steady at $20. And that was one of the few stocks in my Roth portfolio before I handed over to a financial advisor that was up, while everything else, because I was very tech heavy, everything else had dropped down 20, 30, 40%. AT&T stayed relatively positive for me the entire time. Again, I was at $18. Still hasn't dropped below where I initially bought it in at. But if you look at year to date, 1 year ago, you're down 11%. Year to date, you would actually been up almost 1%. Again, it's positive for the year. Most things are down. Another one I would even go as far as if you are interested in getting into a REIT. I like IIPR, which is the marijuana company. That one's down significantly. I could type it in here real quick just to show you guys. I've been keeping an eye on that one. I just started buying it when it dropped to 120. But that one's down quite a bit. But if you're looking for something that has a potential return in the future, this is anyone to get in the marijuana industry. This is one of them. It pretty much rents out to like grow houses and stuff. It is a REIT, but again, REITs are down. They're going to take a hit. Out of all of them, I would think that this one was more promising, and I cannot tell you how far it's going to drop, because who knows? It's been taking a pretty bad beating. It was all the way up to $279. Now it's at 108. I definitely think it's probably going to break below 100. But if you guys, again, are into REITs, and instead of doing Simon Property Group, instead of risking $95, take a look at this one, Medical Properties Trust. This one's also down just as much as Simon Property Groups, but it's the Medical Properties Trust. It is literally a REIT for medical facilities. Do you think medical facilities are going to go away? I think malls could potentially go away. Are hospitals going to go away?
Mark, if this was in Canada, I'd buy it because it's all government funded. So government's not going to cut the funding regardless of recession or not. So yeah, I do more research, but like, I don't know if they own homes and stuff for old people as well. Like, I'd look into that as well, because people
it's
get
multiple.
pension.
It's a multiple. They have multiple assets. Again, do due diligence on all of the things that I'm talking about. But I'm just kind of showing you guys, if you had to choose between malls or healthcare facilities, which one would you choose? Not only that, look at the price. You still get the dividends that's very similar. It's 8%. So it's actually a little bit more than Simon Group. But again, do whatever you guys feel like you need to do. If you think malls are going to take off here in the near future, go for it. I'm just giving you my thesis that I don't think that this is a good play. And then there's other dividend stocks out there that could do way better. There's multiple REITs out there that will probably perform a lot better and bounce back a lot quicker once the recession is over. It's pretty much all I got on that one. So let me stop sharing there.
One thing I'll add, Mark, is like the dividend yield, especially the shaky companies, they're the first one to lower the yield when the economy gets tough. So don't marry that 8%. It's not guaranteed. When we had COVID, SPG lowered their yield like 3 or 4 times. So if you think it's 8% now, it might not stay 8% if we had hit a recession. It might go to 2%. And when you're picking dividend stock, ask yourself, why are you doing it? Are you doing it for capital appreciation or cash flow? most of the time it's cash flow. And like Mark said, to make $1,400 a month, you have to put a large sum. So anywhere from 250 to 450, depending on your risk, right? And some people say, yo, I want to do both. And that's when you want to look at timing. So I know people that added SPG at 46, and then it went all the way to, I think, 130, 140, and they were up from both the sides. And that's because the economy was growing. So malls do very well because you're handing people $2,000 subsidies to go spend money. And this is in Canada, and you're giving small businesses loan, and they were all going to malls, all stores. So business was booming. Now, the way I look at it is, what are the 4 items you're going to cut off from your buying, and what are the 4 items you're going to add, right? Are malls one of them? I don't know. Or like going to massage parlor, spa, like it depending on what income range you are, right?
Mhm.
The biggest income range is the middle class, right?
Yep, correct.
So if you look at them, like, what are they going to cut? Are they going to stop doing skip the dishes, DoorDash, Uber? They might just make home. So maybe like, those packages that come that like have all the ingredients, and you just have
Mhm.
to go, like, I'm just throwing something silly, but you have to watch consumer behavior change and what stocks that will impact. That's what you have to look. Like Restoration Hardware sells $20,000 couches.
Yep,
That
and that
happens,
will
like
take a hit.
that impacts upper middle class. I don't think middle class is buying at Restoration Hardware. So like that's the stuff you got to ask yourself.
Yep, but hey, here, I forgot to share this as well real quick, so I'm gonna go back again and share um, this other thing right here. If you are just destined to buy SPG and you just really want it, and you can't change, I can't change your mind. You need this. I want to show you guys the chart on SPG. So if you really want to buy this, again, I'm not a financial advisor. I think I do pretty well with the levels though. This is where I think SPG is going to go. First of all, I circled the areas where it completely dipped, which was obviously during the housing crash, right? Malls were going to get affected during that as well, real estate. And then again, during COVID, it went up, right? Again, we were getting $2,000 checks. People were spending money, but look where it's headed right now. I mean, this, even if you look at the volume, I mean, it's a downward trend, man. It's been selling. And this is on a monthly, by the way. So since, what is it? Since January, we've had nothing but sell. So where I think it's going to go is most likely is going to go to the bottom of that demand zone, which is $57.34. In this area, I would be a buyer. I'll buy some here at $57.34. What about you?
Is this COVID low, that area?
That is COVID low. Yes, it is.
I think I haven't looked at it. I had 46 marked up. I'll have to look again. So that's your demand right there?
Yep.
That's
Yep.
a
That's
month.
the previous, the next level below that one. If it breaks 50, what did I say? 56.48 ish. If it
Yeah.
breaks that, yeah, the next level is actually $47.98.
Yeah, I'd buy around so I'd start adding a 56. I don't think malls are going away in the future, but again, like, man, what's wrong here is a lot of people held stocks for 2 weeks around COVID, and they're like, look, I held. It's not the same environment, right? You might have to hold it for 2 years this time. So
Yep.
like it's not the same. Like,
Yeah, I just think it's way too high. I mean, looking at it, literally, it's broke. It broke so many levels, man. This is lower than, it's currently trading lower than 2008. The price of 2008. It's lower than that. So I would be very careful buying at $95. I would definitely be more comfortable buying at, like I said, at 56 and below. I would be comfortable, but not at 95. That's just me again. But once again, I repeat again, I am not a financial advisor. So, or an expert or whatever you want to call it. So, but that's all I got on that. I'm just gonna let that go. Let's talk about the hot topic for today. You want to talk about that one? I know you
yeah,
know a little bit about. You don't know much about it. I
yeah.
know a little bit more. So let's talk about WWE, y'all. A lot of people slept on WWE to stock. If you looked, I don't know if you know this, Mo, but WWE was actually up for the year, man. It was like 60 some dollars. It was like $68, I think. Here, I got it on my phone. The high was let me go look here. It was $68.73. So this entire year, while everything else was collapsing and dropping down, WWE wrestling was going up. And I mentioned this on one of my episodes on Trading with a Dummy. I call it like Dummy Talk, where I just kind of just talk about whatever's on my mind. And a lot of people don't realize that World Wrestling Entertainment is more than just a live event show. So that's what I thought initially. But it was about 2 years ago I started looking into WWE, and I was like, wow, they're actually very diversified. They have a movie production company, which they make money off of. The live events, of course, which did take a hit due to, the pandemic. But they also have streaming services. They have licensing deals. They sell merchandise, especially toys, board games, clothes, belts. I mean, you name it, they're selling it. And then, of course, like I said, the live events as well. So there's a lot of stuff that they make money off of. Hence the reason why the product kind of sucks. If you watch WWE compared to like the back in the day when I was like heavily into it, I was into it as a kid during the Hulkamania, and I was really into it as a teenager during the Attitude Era. And then now it's kind of shifted towards family friendly, because they need to make that money off of the kids and sponsorships and advertisements and all that stuff. So they make a lot of money, and they have their own streaming services, and they just made a deal with Peacock as well. So they were making a lot of money, but scandal happened here. Vince McMahon, the owner of WWE, is getting investigated by the board of directors for spending nearly $3 million in hush money to women that he slept with. So that did not look very good for the company. He did step down as a CEO. And that to me was actually very surprising, because I mentioned it on my channel the day before he stepped down, where I was like, this is not looking good for WWE. I definitely think the stock is going to go down. I shorted it in my fantasy league group, and I made a killing off of it. But again, it's fake money, but I knew it was going to go down because of the news. But the fact that Vince McMahon stepped down, that's a huge deal. People got to remember, he went through the steroid trial, didn't step down. He went through Chris Benoit killing himself and his family. He survived that. He went through multiple overdoses from their athletes, brain damage trials. I mean, it's like so many things that he went through that he survived, but this one he didn't. And what's funny is before I joined the military, I was really into wrestling. Let's just say like I was heavily into the wrestling business, okay? And it was kind of a known secret, I guess, that he was a cheater. He wasn't faithful to his wife. My understanding is him and his wife aren't even really together. They haven't been together for years, but they kind of stay married for the look of the company and everything else. So I was very surprised to see that this is what's going to take down Vince McMahon and the WWE. So he stepped down a couple of weeks ago. Prior to that, apparently his daughter, who he was grooming to take over the business, her and her husband, Triple H, they were supposed to take over the business, but he refused to step down. So about a month ago or so, a couple of weeks ago, she stepped down from a business and walked away from a business. So his son already walked away from the business a long time ago, came back temporarily, and then walked away again. And she walked completely away from the business. So that was very shocking. But now she stepped back in, and she's now temporarily the CEO of WWE. And we're going to see how this plays out. My assumption is not that the fact that he, was cheating on his wife. That is what it is. I think they're trying to see if he used money from the company to pay off these women, or if it was his own personal money. And I think that's the investigation that they're kind of probing into to see what's happening. But he stepped down. This is very interesting. I don't know where it's going to go from here. This is like a real life Succession show that's playing out in front of everyone's eyes. What's your thoughts on that?
I think do you think he might be forced to step down so he doesn't interfere with the investigation with everything
I think so, yeah, because he's still in charge of creative, my understanding. So he still is in the day-to-day operations. Dude, it would be crazy if he literally loses the company. Like, this is the thing that he created after he bought it from his father 40 years ago and turned it into this empire that it is right now. Man, I hope he doesn't lose it. I hope the company remains under the McMahons, because it's a legacy company, But this is not looking good. I definitely think the stock is going to get affected by it drastically. I think this is just the beginning phase of the stock tanking, in my opinion. I think it's going to go below 60. I made money off of it a couple of years ago. Once I did research on it, I did a call on it for a couple months, and I sold it right before WrestleMania, and I made over like 200% on it. I was very happy. But this is insane. I don't know, man. It's going to be very interesting to see this play out. I would say be very careful, but keep this stock on radar, man. Even for you as a trader, I'm sure you probably short the shit out of it. But everyone else, I just think as a long-term investment, it's been performing relatively well for years.
Yeah.
So
Do you have to
yeah.
pay subscription for it, like right now, or it's just part of the
Yeah,
cable package?
so they did a deal with Peacock, so you have to have a subscription service to Peacock to watch
How much
majority
is
of
Peacock a month?
dude, I don't know, maybe probably $10 or something.
Okay, I'm like, it's
Yeah.
not like pay-per-view, like $100 a month or something
No,
crazy, right?
no, and that's the thing where I remember because again, I like to listen to like some of the old school wrestlers talk on their podcasts and stuff, and that was one of the biggest transition for the company because the wrestlers used to make money off of the pay-per-views, right? If you were a
Yeah.
high performer, if you're like a celebrity like The Rock or whatever, you get a percentage of the pay-per-views. Well, they kind of got rid of it. I don't even think they do pay-per-views anymore. You watch everything on the streaming services. So it's not like people are paying $45 anymore to watch a pay-per-view. So I don't know how that whole deal works with these wrestlers. I know that the product has suffered. I've heard that they're never going to make another superstar. John Cena was like the last one. Because if you keep up at all, I keep up with the gossip every once in a while. Like you could be like a star in one moment with the WWE, and then the next day they just fire you, like randomly. It's just really weird for like product wise. It's just taking such a hit, but they're making money, man. They're making money. Kids are buying the merch. People are watching. So obviously there's something there to still have the
The
company.
thing is, like, they're making money, but we need to. I haven't looked at their numbers. Like, are they making enough profits? Are they holding enough cash? Like, you look at Disney, that place, like, when I was in Florida, the thing was booked for the
Yeah.
whole month. Like, we had to literally look for dates where we can get in. And when we got in the park, it was so packed that when you go into their merch stores, it actually says you cannot buy more than one or two. That's telling you that they have a demand problem. But if you look at the stock, and from what I know, is the logic behind this, YouTube, Spotify don't have to pay people to create content, whereas Netflix, Disney, they're spending so much money
Mhm.
making content, and most of the content isn't really doing that well. So, and
Yeah.
then ad spend's
Also,
gone down. So
yeah.
people aren't, and Netflix doesn't really, it doesn't show ad. YouTube does show ad.
Mhm.
Spotify shows ad. So, like, business model isn't working. I'm pretty sure WWE will face competition too with, like, I don't know if you know this, monkeypox is real. Like, it's actually, there's legit breakdowns happening. And if this becomes anything like COVID, like, I didn't take COVID seriously for the longest time until it became too hard or too big to ignore. I don't know what's happening with the world, but I think I said this a year ago or around November, not a year ago, 6 months ago. At the end of the day, it's going to come down to people thinking about the next year if they can feed their family versus buying the dip. And that's why I
Mhm.
think trading is the best skill. If you want to invest, use the profits, invest it rather than use your own hard earned cash.
Yeah. Yeah, man, it's gonna be crazy. Disney, yeah, Disney's very interesting because I think they're mostly taking a hit because of political reasons as well. So, people don't like play with their kids, bro. People don't like playing with their kids and sexuality and all this other stuff. So we'll see what happens, man. But on to you, Mo. Let's pull up your chart here real quick because we're getting there at the time. We're a little bit over time, but you ready to get down
Yeah.
on what we got? All right, let's pull that up. You got
Okay.
it.
So
Perfect.
I'm going to break something down for you. So I'm going to give you an example. I'm going to introduce you to the concept of supply and demand, and then maybe next episode we can go dig deeper into it. So, a lot of you guys understand support and resistance, right? It's pretty much similar to that, but instead of thinking in levels, think in zones, which is what Mark was talking about. So, have you ever had a chance to trade, and basically what happens is you put in a level, it breaks the level, so you're like, oh, I'm gonna get out of the trade, and then it bounces right off, and then the stock goes in the direction you want it to go. And part of it is because, I don't know if you know this, market makers and funds can actually see where the stop losses are placed. They don't know where you've placed it, but they can see where the stop losses are placed. So it's something called stop loss hunting, which is why I find supply and demand more accurate. Support and resistance are more so historical area where price has bounced off. Supply and demand are areas where they're active areas where price demands off. So I feel like they're more recent, and that's why I've had more success with them. Um, I'll give you an example and let's see if it makes sense for you. So let's say Apple is at $130, right? $131. Bank of America comes in and says, hey, we want to buy 100,000 shares of Apple, and we're going to buy that 130. And the reason they want to buy it at 130 is because if they just put in a market order of whatever price Apple is at, this influx of demand will increase the price of Apple. So what will happen is, let's say they're buying 100,000 shares, 10,000 will get filled at 130, 20,000 will get filled at 135. So the price will keep rising because there's this sudden influx of demand. So instead, what they do is they will put in a price order for a certain amount. So in this case, what we see here is, let's go on 1 day. And so you look for previous demand areas. So I'm going to zoom in, and you can hold me to this. When you see the price dip there, you're going to see a bounce. So make sure you're matching this with volume. If there's a low volume day, they can fake you guys out. So, okay. So this is perfect. We found daily demand right where it's at. This is perfect. So this confirms your SPY thesis too, because we never broke it. So the next candle should be above the demand. So this is perfect. So this is the demand area. So in other words, what we're saying is this is a zone where there's buy orders stuck. If Mark and I wanted to buy 100 shares of Apple, that doesn't really move the price. When funds and market makers, they want to buy big quantity, that's what moves. And our job is to catch those areas and get in with those orders. So hold on, sorry. So what we do here is, our job is to wait for it to bounce above the zone so we can enter it. The reason why I like this over other indicator is because it's watching price and volume live. So this isn't something that's happening after, this is happening live. When you talk about moving averages, what are moving averages? They are averages taken, right? So let's say you put your moving averages 10 and 20. What that's telling you is when 10 crosses 20, 10 candles, you can take 5-minute candle, 10-minute candle, when they cross, either way, it shows you a change in trend. But people like us that are trading weekly charts, that are trading scalping, I believe it's a little bit too late when you enter the trade. I know a lot of people trade moving averages. What I would encourage is use supply and demand and combine it. Just don't do it based on that. If you're using support and resistance with moving average, that's fine too. But at the end of the day, moving average is a lag indicator. If you've ever traded live and then done for the day and came back and looked at moving averages, it looks so obvious. Meaning you look at it like, oh yeah, this is where it crossed, this is where I should have entered. But when you're trading live, it's not that obvious because it's a lag indicator. It's not a lead indicator. The only two lead indicators is price action and volume, and supply and demand takes that in consideration. That's why I like it. Similarly, so this is a demand zone. This is where the orders were. Now let's say they're like, okay, we're done with the 131 price, we're happy with it, and it was just a trade for them. They're like, we are going to put a sell order around 144 to 148 area, and then they put in the order. So you're going to see when we get to this level, we're going to start selling off. Now, because the area we're using daily is so large, the zone are so large, we can go on 30-minute area and we can find better zones. So hold on. So this would be a supply zone because the moment the price reached here, it's sold off. The way we identify supply and demand are areas where you get an opposite candle. So if you're looking for a downward move, you look for a green candle followed by a parabolic move downward. And when you're looking for a call, you get a red candle followed by a parabolic move upwards. That's all I'm going to cover. And while we're ending this, I want to let you know that next week marks our 10th episode. So look out for our Instagram and make sure you guys are following us there. I know a lot of you guys are on YouTube, but make sure you guys are following us on Instagram. We're going to be doing a lot of giveaways, and I don't want to give in too much, but you're going to see more of that on Instagram. I'll pass it on to you, Mark.
Yeah, definitely follow us again. You can follow Mo at OTB Clubhouse and me at Trading with a Dummy, as well as Money Market Truths. You can reach us there as well. We're a lot more active on our personal pages, so you probably have a better chance to reach us there directly. But keep an eye out because when we post and tell you do this episode what things we're going to give away, we're going to post it on all three pages. So definitely pay attention, subscribe, and as usual, come by, swing. And if you guys actually listen to us on Spotify at all or Google, let us know. Because we look at the analytics, it seems like we're doing a lot better on YouTube, which is great. I know people visually like to see who's speaking, and we're going over charts and stuff like that. So it kind of just makes more sense for you to watch us on the YouTube. So, but definitely let us know. Comment below. Tell us where you guys typically listen to us at. Is it on Spotify? Is it on Apple or Google? Or is it on YouTube? So, but I have nothing else, man. We're really excited about this 10th episode. This is fun for us. Like literally, this is fun. We're doing this. We're not charging. There's no paywall here. We just really have fun doing this. This is like a form of therapy for both of us. And it's just two friends with two different opinions on the market most of the time. Like, again, I'm more of a long-term investor. Mo is a trader. So I think we work very well together and give you guys some valuable information here on this podcast. But other than that, Mo, do you have anything else? I'm pretty good.
The only two things I have: risk management and discipline. Everything else is bullshit. That's it. That's the truth.
Yeah, really. That is 100% the truth. Remember, and knowledge is power, everybody. So once again, I am Mark, and this is
Mo from OTB Clubhouse.
Yep. And again, we drop an episode every single week. You're gonna get good at this, Mo. Trust me, you're gonna get good at this eventually.
I doubt it. But
on every single week. So make sure you subscribe. Click the thumbs up if you enjoyed this episode. Share this with friends, of course. Click that bell button to get notified every single time we drop an episode. So until next week, our 10th episode, remember, we're gonna have some giveaways. So stay tuned, look out. Until next time, peace out, everybody. This is the part where I'm supposed to play the outro. There you go, guys.